All right, now the safety net that is protecting shale oil producers against plunging oil prices, well, that's about to give way. Before the dip in prices, shale companies dished out billions of dollars for insurance that would guarantee them a minimum price of $90 a barrel. Now, some companies' payments account for more than 15% of their first quarter revenue. Now that insurance is about to expire, and for a look at the effect that this is going to have on the shale oil industry, I want to bring in Bloomberg's own Asjylyn, Loder. Good to have you here. Thanks. All right, so explain this whole idea of, you're an oil shale producer going back into time a little bit, and you see what? You see an opportunity to lock in a price at what, 90?
Yeah, going back a year ago. And keep in mind, all of these companies, or most, spend more money than they make, and they sort of make up the difference with debt. Well, a year ago, they were all looking at prices around $107 and thought, hey, I can lock this in. I can sell next year's oil now, and I can get prices of, $90. Well, today, with oil prices at 58, they can't do that. So they're cashing in those hedges, but the hedges are going to start to run off as the year goes on. And you've already seen revenue come down 37%. And when these hedges disappear, it's going to come off even more.
So if these hedges, as you say, they continue to expire in the futures market, what does that mean for the oil shale producers? Do they close up shop? Do they get more money? What happens?
Well, I mean, they're very dependent on their lenders and on the graces of the capital markets right now. So, one of the things that's happened is they have to have these hedges on for a lot of their lenders to continue to extend them a credit line. And as these hedges roll off, those lenders might start reducing those credit lines and saying, you know what, we're not willing to lend you quite as much money as we were when you were still able to sell your production at 90.
Because that was used as a contingency, right? I mean, that was like a contract. They knew that they were going to get the $90 a barrel. Now $58 a barrel.
Yeah.
That's a difference of about, that's $30, right? So
it's a big difference. It's certainly, as one of the producers said to me, he's like, we have hedges for $90 a barrel. Do we wish we had more of them? Heck yes, we do. But we have to it's the oil market. We have to sort of deal with what we're given.